Hello, and welcome to this tutorial on inflation-indexed bonds. Let's start by defining what exactly we mean by inflation indexing. This is where the contractual future payments are indexed to a price level. So it refers to a situation where some amount of cash promised on a future date is adjusted for inflation so that it will buy the same amount that it does today in terms of some basket of goods and services. So this requires that the measurement of the price level be fair and transparent. And this usually requires an official price index. So to measure inflation, a government statistical agency will need to establish such an index. It will need to define a representative basket of goods and services. It will need to conduct a periodic survey of the prices for those goods and services. It will need to calculate the index based on the total cost. And finally, it will need to publish the index periodically. A common index for inflation index contracts is a consumer price index based on the changing total cost for a defined basket of goods and services used by a typical middle-income urban consumer. Now, there will also be other published price indices, for example, a producer price index, a GDP deflator that may be used for based on different baskets of goods and services and used for different purposes. But let's consider our consumer price index, and let's just illustrate this with a very simple example. Suppose we've defined our basket to include 4 items: bread, apples, taxi fare, and rent. And these need to be very specifically defined. The exact type of bread per loaf, then the amount that you would be including in the basket, 30 in our example. The apples, you'd need to define what type and their quantity. Taxi fare, you would need to define from where to where and how much. And then rent, again, what the quality of the apartment would be and where it would be located. So once these are defined, you can then do a survey of prices and find out what the cost of that item in the basket would be and what the total cost would be. So for example, here we've got 30 loaves of bread. The price on August 31st, 2017, we're assuming is $1. So $30 goes into our basket. Apples, we need 60 at a price of 50 cents per pound, which is the price on that same date. So the cost of that is $30. Our taxi fare, we're going to take the taxi 20 times from point A to point B at a price of $2 a piece, so $40. And then the rent for our notional apartment is going to be $100. So our total basket, conveniently enough, is $200. Now, a month passes and the agency would then do another survey of the prices of those same goods and services and reevaluate the cost of the basket. So they would do that. Bread has gone up to $1.02. Apples have stayed the same price. Taxi fares have gone up slightly. The rent has gone up slightly. So we price every item in our basket. We get the cost of the basket now at 202.60, an increase of 1.3%. And of course, that'll be an average increase of the various items in the basket weighted by their quantities. The increase for individual items will vary around that, as you can see. Now, once we've defined this basket and have a mechanism for basically pricing the basket, say every month at month end, we can start compiling statistics. So let's say our basket has these values on different dates: $200, 202.60, and then it goes up to here and to here. By the end of the year, it's at 208.50. And suppose there's some base period, it could be many years in the past, where that basket cost, say, $80. So we use that base period to define the index level. Well, first, we can look at the individual monthly changes, of course, from one month to the other, but it can be much simpler if we turn it into an index. So we define the index as being the cost of the basket defined by the cost during that base period. So if the base period costs were $80 and the cost at the end of August of 2017 were $200, then the index would have a level of 250. That would be $200 divided by $80. So essentially it's saying the basket cost 2.5 times as much, or 250% as much as it did during the base period. And so then we can define the price index for each point that we're looking at, each month end. And then we can ask questions like, what was inflation for the fourth quarter of 2017? And that becomes actually pretty easy to answer. So we would look at the level of the index at the end of the fourth quarter, and we look at the level of the index at the beginning of the fourth quarter, the end of the third quarter. We look at the change over that period, and that's the answer to our question. So we take the 260.63 divided by the 235.25 minus 1, and we get a 2.91% change. That was inflation for 3 months over that period. Now, many countries produce these indices. This is the one for the US, where the base period is 1982 to 1984. And you can see it's been back calculated to periods prior to the base, and then it continues to be calculated going forward. So let's get back to inflation indexing and see how we apply this. Suppose, for example, you are promised a payment of $1,000 in 10 years indexed to inflation. So what does that mean? The actual nominal amount of money you are due in 10 years will be enough to buy what $1,000 could buy today, according to an official index. For example, it's the CPI. And so if the CPI rises from 250 today to 500 in 10 years, you will need twice as much, so $2,000 in 10 years to buy what $1,000 could have bought today. So that's what you would be owed. You would be owed in 10 years $2,000. That would be $1,000 indexed for inflation. So why is this useful? Well, it's useful because future inflation is unknown. If future inflation were known with perfection, we wouldn't need to go to all this trouble. We could just include that in the interest rates. But since inflation in the future is unknown, there's actually risk to both borrowers and savers to nominal contracts. So inflation index protects savers by basically guaranteeing the purchasing power of what they'll receive. So this is particularly important over long periods of time where you might have someone saving for retirement, and they know that the amounts that they're promised in retirement, say, have similar purchasing power to what money has today. But it also, and this is less well understood, protects borrowers. This could be for any borrower, but in particular, it's important for government borrowers who will now not have a conflict of interest in maybe efforts to fight inflation. They know that if they succeed in bringing a high inflation rate down, that their nominal debt service will remain in line with nominal tax revenues, both lower than under a continued high inflation scenario. And that can mean that the success in fighting inflation doesn't create problems of affordability of their debt in the future. So let's look at some illustrations from both points of view. So first, from the saver's perspective, suppose general inflation is represented by cost of bread. And we do this just to make it a little more tangible than sort of the CPI or a basket of goods. So think of the cost of bread as just kind of representing everything that you might buy. But by doing it this way, we can sort of talk about loaves of bread. So let's say bread costs $1 per loaf today, and inflation over the next 10 years is expected to be 10%. What is the expected price of bread going to be in 10 years? Well, that's easy. We say $1 per loaf times 1 plus 10% compounded for 10 years leaves us with $2.59 as the price of bread in 10 years. Okay. Now let's say that the saver invests $1,000 for 10 years at a nominal rate of 12.75%. What will their account balance be in 10 years? In other words, how much will they have accumulated? And compounding that 12.75% for 10 years, how much will they have? So we're going to do this calculation. I'm going to say $1,000 invested. We're going to earn 12.75% per annum in nominal terms, compounded for 10 years. So we'll have $3,320. That's how much our saver will have. So how much bread does that buy in 10 years? Because that's what they're going to eat. Well, they have $3,320, but bread's not going to be $1. It's going to be $2.59 per loaf. So in 10 years, the saver will be able to buy 1,282 loaves, more than the 1,000 loaves today. So they're getting ahead. But now remember, inflation is uncertain. So we don't know that inflation is going to be 10% per year for the next 10 years. It might be higher. Suppose it's 20%. What does that do to the price of bread? Well, Let's do our calculation again. Let's say it turned out to be 20%. So $1,000 per loaf times 1 plus 20% compounded for 10 years. That's going to mean our bread's going to cost a whopping $6.19 per loaf, much higher than the $2.59 that we would have gotten with 10% inflation. So how much bread does our $3,320 buy now in 10 years? Well, we're going to divide the 3,320, which is what we're promised in nominal terms, invested at that 12.75% rate, and we're going to divide that by 6.19 per loaf, and we're only going to be able to buy 536 loaves. So it's less than the 1,000 loaves today, and it's certainly less even than the 1,282 that we were expecting to be able to buy with our investment. So we're much worse off than we anticipated. Okay, so let's look at how we think about nominal rates with this uncertain inflation. The saver invests $1,000 for 10 years at a nominal rate of 12.75%. So we've already calculated our future balance, $3,320. So we've already done that. Let's look at what that we don't know what the inflation is going to actually be. We're expecting it to be 10%, but it might be 5%, it might be 20%. So if it's 5%, the cost of bread is going to be $163. It's going to be 10%. We already saw it was going to be $259. If there's going to be 20%, we already saw it was going to be $619. So huge variation in the possible price of bread in 10 years based on these differences in inflation and realized inflation. And so what that means is that we're going to have the same $3,320 in all three of these cases, but how much bread that buys is going to vary tremendously. So we might have more than 2,000 loaves. We might have a bit over 1,000 loaves. We might have a bit over 500 loaves. So like almost a 4-factor range in terms of what we can buy. Now, this tutorial's about inflation indexing. So we want to get around this problem by creating an inflation index contract. So instead of investing at a 12.75% nominal rate, the saver is going to be promised a lower real rate, 2.5% per annum. So in other words, the saver is going to get 2.5% per annum plus whatever inflation or adjusted for inflation. So what does that mean specifically? So we're going to get our 2.5% real on the $1,000 investment indexed to whatever the realized rate of inflation turns out to be, whether it's 5 or 20 or something else. So let's go back to our table where we're looking at these different inflation rates, the different cost of bread that we would get based on those inflation rates. Now we've got an account that's invested that's going to earn a real rate of 2.5%. Compounded with the actual inflation, not the expected inflation. So if actual inflation turns out to be 5%, we're going to get 2.5% real and 5% adjustment for inflation. So we're going to end up with 2,085. If inflation turns out to be 10% that we'd expected, well, in that case only, we'll get 3,320. If inflation turns out to be higher, 20%, we're going to get much more. Now you might look at that and you might say, that's very risky. We don't know how much money we're going to get. We could get only 2,000. We might get almost 8,000. Do we really want to do that? But look at what matters. How much bread can we buy? So the loaves of bread afforded with these very different amounts are all going to be about the same. And they will actually be exactly the same. The only reason is rounding. So if we've rounded our price of bread to the nearest penny, that explains these very small differences. So essentially, we're going to get approximately 1,282 loaves, 1,280 loaves of bread, regardless of what the rate of inflation is. Very different nominal dollar amounts, but the same amount of bread. So let's look at this graphically. We've got 3 different inflation scenarios: the low inflation 5%, the expected inflation 10%, the high inflation possibility 20%. And this is what the price of bread is going to be in each of those 3 cases. If we have nominal contracts, we're going to get the same amount of money nominally, but the amount of bread we get in 10 years is going to vary tremendously. So we've got high degree of certainty on the nominal ones, but a high degree of uncertainty on what presumably we care about, what we can do with that balance. Now let's contrast that with real rates if we had contractual real rates with uncertain inflation. So in this case, we've got the same variation in their price of bread. Our account balance now is going to vary. So these are the numbers we calculated before. A very little amount nominally in the low inflation. We're going to get a lot of amount in the high inflation, but what it buys is going to be the same. So we've got no risk here. So before we had no risk in the nominal balance, but risk in what we could eat. And here we've got nominal risk, but no risk in what we can eat. Okay. Now that was from the saver consumer point of view. Let's consider the borrower side of it. Borrowers, either businesses or government, need to repay debt out of revenues. And those are going to tend to rise with inflation. So if you have a high inflation environment, yes, your costs are going to go up, but your revenues are going to go up as well. In general, right? There will be, of course, variation around the general trend. But in general, they will go up with inflation. So let's suppose the borrower's revenues today are $1,000 per year. So right now, they're earning $1,000 per year, and they're expected those revenues to grow at a real rate of 4%. So that's real. So if inflation's low, they'll get a lower nominal growth. If inflation's high, they'll get a higher nominal, but the real rate's expected to be 4%. So how would we expect their revenue in year 10 to cover the previously calculated nominal debt of $3,320? So we're assuming that they borrowed. They were on the other side of this nominal contract, and they borrowed $1,000 per year at the nominal rate of 12.75%. So they owe that nominal debt regardless of inflation. So what happens? Well, their revenue is going to depend on inflation. So in a low inflation environment, they're going to have lower revenue, in this case, $1,200 to $2,400 roughly. And in high inflation, they're going to have much higher revenue, okay? But then we want to say, how well is this revenue going to cover their debt repayment? So they owe this $3,320 regardless of whether they have high nominal or low nominal revenue. So in the low inflation case, they're actually in trouble because they have basically incurred a debt expecting inflation to be about 10%, but inflation was around 5%. So their nominal revenue didn't grow as much as they expected. And so they're going to be a little bit short. Now they're going to luck out if inflation turns out to be much higher because they're going to have a lot of revenue in that case. And so they'll be able to cover it very well. But they've got a risk here that they were sort of expecting this situation, but they might have this or they might have this. Now, let's say the borrower says, all right, I'll do the inflation index contract as well. So I'll agree to pay a real rate of 2.5%. And that's represented by these the inflation index due in 10 years. And you can flip back to a previous slide. We did those calculations already. So we saw when we were looking at the savers case, what that would be. 2005, 3,320, 7,926, that corresponding to different inflation rates. All right. So this is if they did the nominal debt. So we want to compare what happens if they did inflation index debt. Well, what do you know? It's all 116%. So the reason is that this inflation index debt is going to be low when the revenue is low, and it's going to be high when their revenue is high. So they're essentially hedged against the inflation. So they're going to basically be able to cover the debt repayment with a little bit of a margin, regardless of what the actual level of inflation is. And so that reduces their risk. So we can look at this graphically as well. These are the revenues. So instead of looking at the price of bread, we're looking at their expected revenue under different inflation scenarios. How much they're going to owe, the account balance or the amount due on their debt is going to be the same if they did a nominal contract. And so their coverage ratio is going to vary a lot. So this means they're in trouble. They're not covered. If this one, they're okay. And then this one, they've lucked out. Now, let's contrast that with the real contract. So if their debt was inflation indexed, the amount they owe is going to vary, but notice it's going on the same pattern as their nominal revenue. So when nominal revenues are higher, their amount owed is going to be higher. And so their revenue to debt service is going to be about the same in all three inflation scenarios or any inflation scenario. So this brings us to the concept of inflation index bonds. Before we were looking at inflation indexing contracts in general, but how do we actually implement this with a bond? There are different ways of doing it, but the most common structure for inflation index bonds is to express the coupon in real terms and adjust the principal for the actual inflation. So in other words, what we would do is we would have an amount of principal that was borrowed or face value owed at time zero, and then that principal would be adjusted according to the change in the price index, represented by PI, versus what the price index was at the time the debt was incurred. So if the price index doubled, then the principal owed in nominal terms would double, but its real value would be the same. And then the interest will be a constant coupon rate on that indexed principal. So the interest will also be going up in terms of the actual inflation or rise in the price index in nominal terms. Now, let's consider a specific case. So several countries do have inflation index debt. The largest one is US government, US Treasury. They've issued something called inflation protected securities, Treasury inflation protected securities, or TIPS. And let's consider a problem where we have a 5-year US TIPS that has an original face value of $10,000 and a coupon rate of 1% semi-annual bond basis. So it means it's 1% per year, but they're going to pay basically 1/2 of that every 6 months. So the question, we have a number of questions we want to ask to see if we understand this. So let's start with this one. If CPI increases by 3% over the first 6 months, what is the first coupon payment going to be in dollars? So maybe if you like, you can pause and see if you can get this, and then I'll show you the answer. Okay. So the principal in 6 months, first we have to index the principal. So the principal in 6 months is going to go from $10,000 to $10,300, reflecting the 3% inflation over the first 6 months. So notice it's not 3% per year, but it's 3% over the 6 months. So that's going to be 10,300. And then the interest is going to be basically the coupon rate. So since it's US Treasuries, they pay semi-annual. So if their coupon rate were 1% per annum on a semi-annual bond basis, it would be 1% divided by 2 times that 10,300. So they would not be paying $50, they'd be paying $51.50. Okay. Now suppose this 3% per year, which is going to be, of course, a bit over 6% annual, 3% every 6 months inflation continues for 5 years. And that'll be a bit over 6% per annum. What is the final coupon payment going to be in dollars, and the final principal payment? Well, let's do with the principal first. So the principal, the original principal is 10,000, but that's going to be adjusted for inflation for basically 10 periods, 10 6-month periods where inflation is going up 3% per 6 months. So the principal is going to be 13,439. So that's the nominal amount that would be owed on the TIPS, and that's reflecting 3% inflation every 6 months for 10 periods or 5 years. And then the interest, the last interest payment, is going to be off of that same 13,439. So we're still going to be getting a real coupon of 1%. So 1% divided by 2, since it's for half a year, times the 13,439. This will be the final coupon payment. So this will be the amounts that would be paid in the last period. This 13,439. Principal will be repaid, and the coupon at that point will be 67.20. Now, let's go. How do we analyze these? Because they're kind of complicated, right? The principal's changing, the coupons are going up. Well, typically you would look at the yield to maturity on these as if there were no inflation. So what does that mean? So if the TIPS was purchased for 101.50 6 months after issuance, so 6 months later, what would be its yield to maturity? Now this, I should point out, this 101.50 is going to be 101.5% of whatever the face value is at that time. So it wouldn't be 101, it wouldn't be 101.5% of 10,000, it'd be 101.5% of this 10,300. But we actually don't need to worry about that. What we will do is the following. First, we would say, all right, 6 months has passed, so we've got 4.5 years remaining. So we got 9 periods. So we'll put that in the end register. We're gonna this is a mistake. There should be a positive 101.5. 101.5 minus 1 minus 100. Okay, and we calculate the yield. Now that's going to be the yield per period. So 0.33 in this case, so very low. So to turn that to a yield to maturity on a semi-annual bond basis per annum, we would just double it. So it becomes 0.66%. So that would be the answer. What that means is that's what we're earning. Now, is that a real or a nominal yield? Well, of course, that's a real yield because we haven't adjusted any of these for inflation. So we've essentially treated this as if there were no inflation, or another way of thinking of it is we're just looking at it in real terms. So that's it. Let's just wrap up with some concluding observations. So when future inflation is uncertain, both savers and borrowers are exposed to inflation risk, and we saw that with our illustrations. If inflation's higher than expected, the saver will receive nominal payments that don't buy as much in goods and services as they'd expected, and so they're harmed by that. And if inflation is lower than expected, borrowers may find nominal debt owed will be more burdensome relative to lower than expected nominal revenues, and that is a risk to them. Inflation indexed debt contracts, for example, US TIPS that we just looked at, can reduce inflation risk for both savers and borrowers. So that's it. Thank you for listening.